Senior is a FTSE 250 company that's in the Britbox, but we've never really talked about it in any great depth on the show. So we'll have a bit of a run through and then talk about the trading statement and at least give this some airtime so that we can come back to it in the future, because I think it's kind of interesting. And well, I thought it was interesting enough to go in the Britbox. They issued a trading statement. This was going to be last week, but it's now about a couple of weeks ago. What they do is make equipment for, well, aircraft on the one side. So the one of their businesses, or one side of their business, sorry, is aerospace. The other side of their business is what's called flexonics, which is basically land-based things like industrial applications and trucks and things that are land vehicles, but also land kind of buildings. They are a fluid convergence thermal management bunch, which means they make things like pipes and tubes and ducts and that sort of thing that shift fluids around things like aircraft or cooling systems around vehicles and so on and so forth. Okay, they have a book-to-bill ratio because they're an aircraft building thing, which is quite nice, of 1.34, and that's encouraging because anything above 1 means growth. It's been quite a while since they started putting up any meaningful growth. They've had a tough time with things lately. Part of the reason for that is that anything that sells airplane parts has been affected likely by Boeing's output being cut in half for the last few years from where it was. Not an awful lot you can do about that, and one of the snags about selling into this kind of industry is there ain't many people to pick up your kind of excess stuff if one of them has a bad time of it, and Airbus, we've seen, has been failing to expand its output very much, maybe deliberately so and maybe wisely, and we're not necessarily critical of that, but it doesn't help the likes of Senior. Anyway, so at the moment, or at least when I wrote this a week ago, aerospace was about 66% of their business, and that split out into two parts. 28% of the total was this thing called aerostructures, which is basically structural bits that go on planes. 35% was this tubes and ducts and pipes and hoses type business. Flexonics, which is 33%, is land-based automotive industrial, all FCTM, fluid conveyance thermal management stuff. Okay, the reason I say that's how it breaks down at the moment is because they are busy selling off their aerostructures division. I said last week on this show, if anyone remembers back that far, that now doesn't seem like a great time to be selling off bits of businesses. We've seen WH Smith put up some fairly disappointing results. We've seen Dowlais put up some very disappointing results. And we've seen DCC most recently, or I've seen DCC most recently, get a disappointing price for its healthcare business. Senior might therefore not be picking the best time in the world to try and divest its aerostructures division. They have, however, found a buyer. They haven't said who it is, and they haven't said how much they're buying it for yet. This stuff will become apparent in due course, but I am unsure what to make of that. Genuinely unsure. Definitely put me down as slightly wary, not because I'm suspicious of Senior per se, but just because of what I've seen elsewhere in the market lately. If you, like me, had been seeing 3 companies try and divest bits of their businesses and fetch reasonably poor prices, in the case of Dowlais, for a similar type of operation, WH Smith was selling garbage, so I don't really mind too much. But DCC, I think, slightly disappointing. You might well be kind of suspicious of this. But why are they selling aerostructures at all then? Well, one answer is because it turns them into a pure play FCTM business. It's now all fluid conveyance stuff rather than bits that go on planes. The other reason, plausibly, is that it takes up 28% of sales and it makes a loss, which isn't particularly encouraging. So they're going to cut that away, and they think that will make for a more profitable business, basically. The 24 numbers were as follows for the overall firm. 1% sales growth, 4.8% operating margin, 6.8% return on capital employed, which is the numbers they report. That is rubbish, pretty rubbish. Not entirely due to the aerostructures thing, but over the medium term, when things get back to level, and they acknowledge very clearly that they are a cyclical business, rightly so. So to some extent, any given year is not entirely under their control, and they deserve not complete credit or complete blame for sales being higher or lower. They are targeting 5% per year revenue growth, 15% operating margins, and returns on capital employed of between 15 and 20% is what they think they can achieve by focusing on FCTM. That is to some extent night and day between the thing that they're currently looking at here. When I looked, they were selling at a PE of 20, which was based on some slightly depressed earnings, but it was also based on earnings that were being depressed by an aerostructures business that's making a loss. So might expect that to come down. It should be kind of profit accretive on this. No word on who or how much. 2024's earnings per share were fairly badly down, about 17%, I think, and strong performance in aerospace and weak performance in flexonics. They're expecting that to kind of continue into this year, but it's an interesting restructuring business, Stephen. I hadn't quite appreciated the extent to which it is an interesting restructuring business. I'd previously been kind of focused on the idea that selling parts for planes is a heavily, heavily regulated industry, and when you're on the inside of that, there isn't much opportunity for your buyers to switch out elsewhere. They pretty much have to buy your stuff from you. That generates pricing power, whether you choose to take that or not. And I quite like the industry if you can get yourself on the inside of it. Doesn't have a massive market cap, but I think it's kind of more interesting than I thought looking. One to keep an eye on, maybe. I'm not throwing myself at this just yet, though, Steve.
It seems a shame that they've basically just done earlier this year an investor day where they've kind of spelled out where this growth's going to come from. So they said that in this investor day, their aim is to outgrow their end markets by about 50% through a cycle. And they list power and energy, which I think will grow by about 2%. I think that must be annualized, all it doesn't say. Land vehicles, which they think will be 2 to 3%, and aerospace and defence by 3 to 4%. So they want to do 50% more than that. So you're really looking at growth on your aerospace and defence as being the key driver if that continues going on. But obviously, we may be chopping that off soon, lopping that off. So they're looking at end markets of land vehicles of 2 to 3%, 50% higher than that, 2% power and energy, maybe 50% higher than that. But what I think is key, Steve, is what you mentioned, and I'll just reiterate it for people, is that they think they can do adjusted operating margins of about 10 to 12% on the flexonics, which will lead to about 85% cash conversion and up to 20% returns on capital as well. So if they can do that with and they do say as well with a strong balance sheet with leverage at between 0.5 and 1.5x, you should see a movement in the share price, Steve, if they can do that. And that's but you should, because they would be exceptional results from where they are, and that's the big if. So when you're looking at this, you've got to look at where they currently are and say, do I believe that they can get to these three big squares on the Investor Day page 25? And if you believe they can get there through reading this report, Steve, then it would be a fairly obvious buy. But to me, they look like big numbers, Steve, and I haven't got far enough through the report to really see where that's going to come from, other than they think that they're going to sell a little bit more and price a little bit higher. And obviously, some of those margin improvements now, I guess, will come from getting rid of the thing that is affecting margins. But still, it's a big goal. And I think that revenue growth of mid-single digit teens is going to be pretty difficult for them now. So yeah, I wonder where it goes from here, Steve. It's one of those things. I'm always glad to see companies like this in the Britbox, because they're not companies I would generally look at, and I like to read through them and see what the aspirations are and how they're going to get there, and the cost savings and their operational efficiency, and they think how volume affects these kind of businesses. But for me, I always find these kind of tricky, because I always think at the end of it, the top end of the restriction just seems too high, and for me, I just wonder how we're going to get there. And being in the Britbox is the perfect place for it to be, because I'll be able to check on it every year and just see if they are making progress to that, and then perhaps obviously learn from them moving forward, Steve. But yeah, it's a really interesting company. I'm kind of sad to see the back of the aerospace and defence, because it is one of the things that they can really improve on if they were just better at it. And I appreciate it's a very busy business. It's got a lot of competition. You can see that in the competition analysis that's earlier on. Pretty much 5 big competitors that they refuse to name pretty much do everything they do in aerospace and defence. Whereas when you look at all of their other aspects, there are sometimes there's only a couple that do it. So yeah. It's an interesting one for me, Steve. Is it something that you're going to add, or are you in a similar sort of position to me at the moment?
Similar to you, I think. I mean, one question is whether they can hit those numbers, and I agree with you about that. The other question is if they can, then when. And to some extent, as I was saying, the kind of heavy cyclicality, which isn't necessarily their fault, means that when isn't really up to them entirely. It's not just a question of getting their own house in order, which even if you believe they can and will do this, and you think returns will show up sooner or later, you kind of need to model out how much you're going to get and how long is it going to take you to get it. Might work, but there's a lot that can kind of go wrong with these sorts of things, and I realize I've said there's a lot that can go wrong through no fault of the company, really. That being said, as a slightly flippant final point, my sort of sense is that if you really put your mind to it, you shouldn't miss an adjusted operating margin target. Because you shouldn't really miss an adjusted anything target, because hey, you can just adjust it so you do make it. So maybe they will, but it'll be. But I think a slightly more serious point in that, and this is not to impugn the credibility of seniors management or anything like that. Got to be tempting to try and adjust that in various different ways and start getting up to some strange accounting things if you've set a kind of margin target for yourself, working out what doesn't count as a cost, all of these sorts of things. It's always a little bit wary when companies set themselves targets like this, especially, as I say, in a cyclical industry. Debt being relatively low is a good thing, again, because you don't know when you're going to need it, and you can't run a massively leveraged balance sheet. There are some industrial stuff like railroads, I think, that really can, because the businesses are very, very steady, income's very, very predictable. You have a good idea of what you're going to make years ahead of where you make it. This ain't one of those. These are ones that go really great and then really bad, and you need to make sure that your balance sheet is not in a problem when it comes around. Airlines seem to never be any good at doing this, as far as I can tell. But the companies that supply into them, maybe. You've been watching a segment from the Playing FTSE show, brought to you in association with our favourite broker, Trading 212. For the full version of the show, check us out on Spotify, Apple, or wherever you get your podcasts. And if you open a new account with Trading 212 using the link in the description, there's a free fractional share in it for you. Just make sure that you use the code FTSE when you sign up. Terms and conditions apply, and do remember that when investing, your capital is at risk.